I think everyone has a second half of the year earmarked for a lot of activity.
Yeah, and CBRE actually does close by saying CBRE concurs with this view as interest rates fall and financial conditions stabilize. So they're speaking for the company, which is nice. Although I will take this moment to say that my thoughts are mine and mine alone and are in no way representative of Gray Capital as a company. Right. This is a good picture, and it does represent very easily, just at a glance, the difference between 2024 intentions and 2020 and 2023. 2024, they want to buy and they want to sell more. 2023, they want to buy and sell less. And it is almost a complete opposite. Like, you can't get more perfect than this. And I wonder if that's a little bit contributed to the vibe at an NMHC, but
I don't know. But no,
yeah.
I think it was there a little bit before, just more confirming.
Yeah.
Okay, man, this next piece from Moody's: one good year does not solve America's housing shortage. We were just talking about that earlier.
Yeah. Even though multifamily, what did they say? Multifamily completions increased by 11.1% sequentially to a seasonally adjusted annual rate of 509,000 units. At the same time, household formation, choice of location, etc., they finally reverted to normal. One good year of excessive supply was only in its relative term when compared to affordability-constrained demand. There is a long way to go before solving the chronic housing shortage, but asking rent reacted with a modest decline. That's still the point of this is that we need more housing in the country, rental and otherwise. They illustrate this with a graph of housing completions by year, and it bothers me a little bit that the graph doesn't go up to 2023, but I can tell you that the number for 2023 completions is 1.5 million units completed, which is above the 1.1 average of pre-Great Financial Crisis and Great Recession. But as Moody's explains it, after that housing crisis in 07 and 08,
there wasn't a million units completed this year. That's what's under construction. I mean, I think it's 400.
Maybe this
it's 400 some thousand. I think.
Okay. So I'm sorry. Yeah, I had miswritten it here, but 1.5 million under construction, and after the housing, so average units built after the housing crisis in 2008 were only 765,000. So we may be above average for new housing this year. Maybe we will be, and last year we were, but we're still catching up. And as the report really puts it, rather boldly, strongly, whatever, it is important to emphasize that preserving and increasing housing stock to restore a more balanced market will require many years of joint effort and creativity from both public and private sectors. The cost of land and access to construction financing are key factors to consider.
Yeah.
I have heard, maybe it's because Matt Baxter is looking for land, but I keep hearing about how land is a finite resource, and a lot of people are talking about that as
making any more of it.
They aren't making any more of it, but sometimes I think
Get them to buy.
Yeah, just clear out that field and then we'll build there. It's in the right location, and I think that it is worth noting that they still say that financing, they don't speculate specifically on a solution to these problems. Neither Moody's nor, in a second, the Harvard Joint Center for Housing Studies really go hard on, all right, this is what we need to do to solve this problem. We need to do X, Y, Z, and then this is going to happen. They more really call attention to the problem with a lot more rigor than they do potential solutions. However, implication is let's lower interest rates, or I think the other implication is let's lower regulations so that more types of different land open up and are able to be built on. You can build an apartment there.
Yeah. In San Diego, obviously California, horrible housing crisis.
Yep.
We saw people OD on the way to the conference, man, literally.
Jeez.
But one of the reasons why they have such a bad housing crisis and housing affordability crisis is because the restrictive zoning laws. And there was a lot of conversation. We're not investors in California. I paid attention, but if you can't build, you're not going to be able to add to supply. You're not going to be able to continue to stabilize rents. And then there's a lot of data that's been coming out showing how even new construction of luxury apartments can put downward pressure on even C-class rents and B-class rents in some markets.
Yeah.
It doesn't always work. It does not always work out that way, depending on what the supply and what the demand is. But the key to the housing crisis is more housing. It's not a convoluted system. There's a lot of talk, Matt, about this middle income tax credit that may be coming, I don't think it's actually in a bill yet that's going anywhere, but it's a popular proposal, the low-income housing tax credits have basically been the way we've been able to build affordable housing in this country over the last, couple decades. But as we can see, there's not nearly enough affordable housing. And it's not just the folks at the very bottom of the spectrum. It's some of the folks that are in that middle range also, not like middle class, like true middle class folks, but so coming into a new type of tax credit that's more lower middle income, not just very low income. It could be part of the solution, but we got to build. We need market rate. We need tax credit. We need the rest of it. Yeah, that's the solution. And to you were talking about, it's because a lot of localities have restrictive zoning law.
It's funny. It's not zoning laws. It was an article on, I think it was rent control, and I forget specifics. I forget what the source was, but their points on the issue was that rent control, it benefits and it reduces mobility, and it pretty much locks out apartment supply. So there's a lot of negatives that kind of build up when that's associated with rent control. And it may have been in the Harvard Joint Center for Housing Studies, just in a separate report. However, you think about that, right? The people that find that apartment, and it usually benefits older people because they've stuck around there. They're realizing those gains. I don't know how sticky rent control laws are. My guess is very sticky, but
so different because they can be local.
And I have a lot more hope though for regulation, clearing up regulation and allowing people maybe to build an accessory dwelling unit in their backyard.
Which has been a very popular strategy that they're doing in California and San Diego. There's a lot of ADUs that have been going in. Yeah. So let's talk about this JCHF, the Joint Center for Housing Studies from Harvard University, Matt. Again, because so much of the pieces that we look at, they're from like the multifamily industry, market rate, kind of driven by investors, for investors. We're making money. They're different angle, different perspective, much more. If anything, they have bias in the opposite direction. Probably more.
The problem for us is we aren't making enough money, and
they could care less about investors making money. They're just looking at the issue of housing.
They're more like people are spending too much money on housing. How do we make it cheaper? And a lot of times, our motives as investors can definitely align with, and I think it may work best when it's aligned.
It 100% is. And this is what, hey, Matt, you're gonna make me go on a little bit of a
yes.
The interest is aligned.
Yeah.
Without the investment into housing, whether that's new inventory or the maintenance of existing stocks, you're going in, you're maintaining a property, you're fixing it up, you're doing a value add, which sounds evil. But the alternative of not doing that value add is these properties falling into disrepair in conditions where people shouldn't be living in, and then eventually goes offline and gets demolished, reducing supply, increasing rents for everybody else. We need investment into housing, into all types of housing, in order to keep rents stable and affordable. Raising rents a little bit here, while seems okay, you're going to be hurting the renter in the short term. If we can only achieve that by adding value to those communities by fixing them up and maintaining, think about it as maintaining the housing stock. What does it take to maintain a housing stock? It takes money. It takes investment. And if there's no incentive at the end of the day and no return for doing that, no one's going to do it. The government's not going to do it. Even if they can't, if they wanted to and said they were going to do it. So it's on us as investors. So people can say for market rate reasons, for capitalistic, selfish reasons, we want to invest in housing and we're going to make money doing it. But we're also creating affordable housing, and the long overall impact of more investments into housing is a more affordable housing market and more supply for renters. Now, there's bad operators out there that aren't adding value and are extracting value from people and are deadbeat landlords. Screw those people.
And there's also a little bit of a difference in just like the business plan of affordable housing and market rate housing. A lot of what we're talking about every week is the market rate housing world. What RealPage tracks, the market rate housing world. What Harvard is talking about, a lot of it is affordable. It blends. It does not make as much. It will talk about the distinction, but a lot of times they just group it all together, all rental housing. So,
exactly. So
their takeaways.
Apologize for the quick rant, Matt, but people look at you guys are in the apartment business. you guys are the ones raising the rents.
Yeah.
You know who's responsible? It's the Federal Reserve, Jerome Powell, and it's every ordinance that prevents someone from building a house. Those are the people that are raising rents by 20%, 30%. It's the Federal Reserve keeping interest rates at zero for months longer than they should have been.
It is. And I've said this before. It's interesting. Yes, sure. It is a little bit of landlord, but it's also like a commodity. You can go on apartment list or apartments.com and you'll find out, you look at the similar apartments and you'll find they're all hundreds and hundreds of buildings. They're all about the same for the same price. It's not, there are some opportunities out there and that's what we're looking for as investors.
Yeah.
But again, it is like, there's a lot of fish in the sea, and to point at one landlord and say he's making the market, I don't know that. I don't think that works.
Market wouldn't support it.
Yeah.
No. Yeah. All right. So Matt, let's get back into this JCH.
Yes. So they have 6 takeaways here, and then if we can jump to the actual report, which is in the next tab.
Okay. We'll do the takeaways first.
Yeah. The takeaways are, here's 6 of them. 1, rental markets are softening. 2, affordability is worse than ever before. 3, housing instability is rising. 4, rental assistance falls far short of the need. 5, the rental stock has...
I
know, I'm skipping. 5, the rental stock has significant investment needs. And 6, high interest rates are dampening rental market activity. Again, not going to cover all of those. I did want to comment on a couple of them. The first point on softening rents, not really news to people who've been following market rate rents. But the second takeaway on declining affordability is an interesting indicator. First of all, we talk about wage growth growing and rent to income hopefully going down a little bit, but it is a reflection of so many different things, this affordability, including the continued need for new apartment supply, particularly apartments on the cheaper end of the spectrum that you just described, economic factors like wage growth and inflation, and really like the end of pandemic relief measures, which is one of the quotes that they said in there. They all play into affordability, although the numbers on declining affordability may be, like I said, different for market rate apartments. So it is interesting to see that. And I don't know, they don't really pose like a airtight solution, but they say, yeah, this is going to be a problem for like C-class apartments. And I know you did mention that new A-class luxury units coming in. They don't usually build them C-class, but the new units coming in, maybe they will have an effect and lower the price of B units. Then the B units will get cheaper and they'll lower the price of C units. I don't know if that's dipped down yet.
RealPage has a slide somewhere, and I'm going to get all the slides from NMHC, but they may be on a publication we looked at earlier. Basically, it shows in markets, it looked at market rent growth in markets with certain level of supply relative to inventory coming online.
Yeah.
In markets that had, I believe, over 6% of new supply coming online relative
to inventory. I remember this threshold, yeah.
They showed rent growth in broken out between A, B, and C. And in those markets, everything was down, and B and C were down quite a bit.
Okay, all right.
Versus markets that did not have as much supply, it's much more moderate.
Okay, it does make sense. It cascades down, and there's no way that it would increase apartment rents. Although I don't know if it's in the Harvard or some other article I read. There are some people that think as new apartments come in, they're gonna make rents increase. There, it is like this.
That was and that's probably a story, an article, and a study for next week, Matt. But that's a really interesting piece. It got talked about at NMHC.
Oh, really? Okay, all right. So I wasn't.
I think I sent it. I think I
maybe you did.
I sent it to you like as I was watching, listening to the speech. But the misconception of the idea that some people absolutely believe that a new luxury apartment is going to make rents in the whole market go up.
Yeah.
That's just what people think, and it's not necessarily the case. And I think NYU did the study.
Okay.
I want to say, but yeah, really interesting.
Yeah. 5 and 6, which cover the need for additional investment in this Harvard report, that really is our key element, I think, that nicely complement the reporting from Moody's Analytics. And I'm glad that you're jumping into the report here. So on page 4 of the PDF, there's a graph that talks about how apartment demand has started to rebound. They say that, and this is another thing to note here, is not only has apartment demand started to rebound, but the rental stock is older than it's ever been. The median age was 44 years in 2021, up from 34 years to 2 decades ago.
Wow.
We just haven't been keeping up with the buildings. Now, I think that may flow with the population. But still, there are some markets where you could have a net deficit of apartments. And just because they're demolished or whatever, these buildings don't last forever. So it's really interesting to see. And moving on their commentary on higher interest rate covers similar ground as we discussed on Gray Report. Costs too much to get loans, but it's also apartment prices haven't come down enough maybe to make people interested in buying apartments with the high property and interest costs. That's a direct quote from the report. So they're acknowledging where the investor is playing a role here.
Yeah.
But yeah, to shift to demand on page 11, they talk about how rental demand is returning. And I appreciate that this report notes that rental markets are softening. And then, now we're at rental demand is returning. One of these indicators here is a generational one. And it talks about how there's this line graph here, and it shows Gen Z is on the rise now. Millennials, it says that rental demand has shifted from millennials to Gen Z. Really, the acceleration, the growth of the generation is bigger for Gen Z renters than millennials. Millennials are hanging out as renters. I would have to expand this graph out. It looks like millennials are hanging out as renters for a lot longer than previous generations. And I think that's a point that they make too. This persistent lifestyle, renter lifestyle, or maybe interest rates and home prices are too high. They're being prevented. But I think that there's going to be a little bit of a shift, and we're still negotiating what the relationship to a home is. Is it something that you rent? Is it something that you buy? And at the bottom of page 11, I hate to run back up here. There's a graph at the bottom that shows how the number of renter households has steadily increased and keeps increasing. But the rentership rates, that is to say, the percentage of households that are renters and not homeowners, has steadily declined. Now, this kind of tracks with a lot of how much more expensive homeowners been getting. And it does represent maybe an opportunity and a growth in the renting population and increased apartment demand. But I think that also the rentership rate it's still a little bit up for grabs. And I looked at this a lot, and I tried to square with this increase in the population and decrease in rentership rate. And the best way I had of thinking about this was looking at homeownership rates. I had it on the Fred, it's like a graph from the St. Louis Fred, but it uses, I think it's census data on homeownership rate in the United States. And this is what I was trying to mention before about how the patterns of homeownership and housing, really, these are larger stories than a single pandemic swing. You see a spike on this graph of homeownership spike up right after the pandemic, but now it has gone down. And if we're going to talk about how many people rent versus own a home, right now we're about 66% own a home. But I think that we're going to get down to 65% own a home. And if you look at this graph, we are really in the wake of a huge upswing. It went all the way up to over 69% home ownership rate around 2005 and 2006.
Nice.
And now we are at 66. But really from like 1970 to 1995, home ownership rate was around 64, 65. So it's not unheard of that the swing that people could change and preferences could change. I thought that we would be, that our current homeownership rate would be much lower in the wake of the great financial crisis and all of that. People selling their homes and they get underwater, so they decide we're going to rent now. But that hasn't really been the case. It dipped down, and in 2015, it was as low as 63%. It's back.
The millennial coming back to, they're going to stay renters, but there's also there's a lot that are buying homes.
Yeah.
And we're in peak household formation, family formation years, which drive single family investment. And the thing that Jay Parsons said is they're finding a way to do it. They're finding a way to buy a house. Even though it's difficult, people are still going to buy a house, and that dynamic is still going to play out. And we always anticipated that, but on the margins, they are renting more, and there's going to be a lot of folks that are going to be renters for longer, whether that's built to rent, so get the single family home, but you just rent it, you don't buy it. But people that are going to still buy a home, and that makes sense why home ownership rate is going up, is it's just that millennial generation as the Gen Zs take over from there.
There's so much more in this report, but I really appreciated these accounts of the kind of short-term gains and long-term needs for more rental housing, especially on the lower end, and how really declining property prices and rising operating costs. They cover that actually on page 33. Even despite all these issues, you think that maybe it will be giving renters a break. There still is affordability issues, especially on these for lower income renters. And I know we focus mostly on the market rate multifamily world, but the pressing need, and now this is your point was a little bit, and I'm maybe putting words in your mouth, was how market rate housing and new maybe luxury housing coming into a market that could affect housing needs on the other end, right?
I think it's more of net supply, but regardless of supply, a bunch of new luxury apartments eventually can lower the rents in the B and even C class apartments.
And what I was thinking of as
in a growing market, you may still see rent growth, but it may actually will be less. And it's also a time delay of the class A today becomes the class B. And so you have more class B, but in 10 years. Yeah. And so it's again, and you can't just people think of, oh, the new luxury apartment down the street, they're charging $3,000 a month. That's insane. Yeah. Like the rent's high. Who's going to pay that? And it gets everybody, it becomes an emotional argument. And then with the anecdote and the evidence that would be like, oh, that's going to increase rents elsewhere, as the B class apartment owner is like, oh, if they're at $3,000 and I'm at $1,500, well, maybe I can charge $1,750 because I'm still going to be cheaper than them. Yeah. But you still have to meet that demand. And maybe you can, but that's like those two instances. But if you keep having luxury apartments come online, all of a sudden the luxury apartments are like, yeah, we actually have to lower our rents down now to $2,500. Yeah. And then the B class, oh geez, now the $2,500 people are seeing that as a better value as my $1,750 or $2,000. Now I actually need to lower my rents a little bit. Yeah. So I can be the true value option for individuals. So you have to take time into account. It's not as simple, and it's not always as cut and dry either, because every market dynamic is a little bit different. But if we're talking about affordability, the more stuff you have usually is going to make it more available and more affordable. Yeah.
You can't get around that for sure.
Yeah.
I was interested in the idea that even the affordability crisis or affordable apartments themselves, I think that this pressing need for affordable rental housing is not only worth mentioning due to how big the issue is, but also really it's going to impact the market rate side too. Any solution that is going to address the affordable, maybe it is building affordable housing, or I don't know if it's like some onerous rent control or if it's deregulation on the other hand to make houses cheaper for people. That effort is going to bleed into the market. It's going to have some effect. Maybe it'll lead to investment opportunity.
One effect that wouldn't necessarily be great for multifamily. I don't think it would be the end of the world, because housing demand is usually good housing demand. But what happened in the 90s when you had more incentives to the incentivized home ownership, lending got a lot easier, which eventually all led to the great financial crisis. Basically saying, hey, everyone, you get a home. We're going to make financing available for everyone to be able to buy a home. No money down. The government could come up with any program they wanted to. It may be horrible for the economy in the long run, but it's not crazy to think that there may be some federal government incentive program that encourages ownership that could reduce the desirability of rental units, because if you could buy something.
I was thinking even more in a really simple, in the same logic, really. What if a kind of nice government subsidized building came up right across the street from yours? That could also have an effect. Now, I know that gets into a whole NIMBY argument, but.
And they don't do it like that anymore. Maybe it's a subsidized, it's the LIHTC.
So these are investors that are, or developers that are
government got out of that business in the 70s.
Okay. Yeah.
Yeah. So they weren't good at it. They couldn't do it. Go to the project, go to the big towers that are falling apart. That's what the attempt was.
Yeah. And that looms behind your earlier discussion of the importance of kind of market rate and investment in new housing supply. It's the only way we're building housing right now.
Yeah.
So that's really interesting.
Going to happen. Yeah. No, you go to the affordable apartment community, affordable housing, they're nice. They look like luxury apartments. That's the other thing. They're building them like luxury apartment buildings. That's might as well. It doesn't cost that much more to build them. You'd have to try hard to make them bad. So why would you do that? The deal down the street? That's partially.
I didn't know, and I didn't know the ins and outs of it. Yeah.
They have units that they set aside for 60% of AMI, 80% of AMI.
So if you're making 80% of the local income average, then you can qualify to rent this. It's not a whole apartment wherever it's contracted.
Some apartments, are fully LIHTC and are fully income restricted. Others are partially. There's 20% of the units. And so there's different types of tax credits,
Yeah.
and then there's also other local incentives that you can apply for. And the city may say, we'll give you a tax abatement.
Mm.
You don't have to pay property taxes, but we want you to keep all of the rents affordable, or
Yeah.
we would like for 20 units to be at 80% of AMI or 60% of AMI, or whatever income levels, because
Okay.
this is what the greatest need is in the city.
Yeah.
And hey, we'll incentivize you to do this for creating this housing stock. That's been a lot more effective than the federal government or a city being like, we're going to build what we need, housing. Okay, let's build it all here. And it ends up being obvious. Well, it's still a boondoggle, even more of a boondoggle. And then who's going to manage it? Or the government's managing it. Good luck.